Key drivers behind growth in 2010 were the realization of the investment strategy that began with the acquisition of CFC in 2008. Since then, we've actually been investing substantially in both pieces of our business. That's corporate and investment banking, as well as personal and business banking. So you'll note from our results that there's been a significant increase in trading profits, as well as an increase in fee and commission income. The investment in our global markets and treasury business has allowed us to trade additional classes of assets. So while you'll see that foreign exchange income is up by a modest percentage, other income is significantly up, and that's as a result of trading additional asset classes, fixed income, money market, and equities principally.
Looking at your staff expenses, they grew up by 52%, and this is in an environment where banks are looking at cutting on their costs. Probably you can just tell us what is the rationale behind this growth and how is it impacting on your business?
The increase in staff costs obviously is a very significant number. But when we began the process of the merger, it was with a very clear strategic intent to grow our personal and business banking part of the franchise. So it's no good just investing in IT systems and new branches. You also have to invest in people. And critically, we've also invested a significant amount in increased headcount in the risk management pieces of our business, because obviously with additional asset classes, with the expansion into personal and business banking, risk management becomes a key focus. So it's pleasing to see that notwithstanding the increase in costs, we have seen a decrease in the provision for bad debts, and that's consistent with our strategy of investing in both people and systems in order to realize the strategic intent, which is to increase the percentage contribution from our personal and business banking business.
Now, last year in December, you issued a 2.5 billion bond, which was aimed at looking at your enhancing your capital management as well as your liquidity. What has been the progress on this so far?
The bond, as we actually said in the prospectus, was to support those ambitions in our business. Clearly, when you start lending longer term, as you do with home loans and vehicle and asset finance, as opposed to short-term working capital facilities, you need to ensure that the bank has a greater percentage of long-term liquidity. So it's for that reason that we went to the market for the 2.5 billion. And we're delighted, obviously, that it was oversubscribed. And it's a key plank in our strategy of actually diversifying our sources of revenue by customer and by segment and by product. So home loans, you will see, will be an increasingly important focus of our business going forward.
Now, seemingly the buzz in the financial sector is expansion within the region, and we're seeing other banks also looking at growing locally. How does this fit into CFC Stanbic's growth profile?
Yeah, I mean, clearly we also have our own growth ambitions and an investment strategy behind that in order to realize the growth. Our main focus will continue to be the Kenya market because we are part of the Standard Bank larger group. But having said that, we've spent a lot of money post-merger, and while we will continue to invest, the pace of investment is likely to slow over the next couple of years as we make sure that we reap the benefits of the investments that we've already made. So Kenya will continue to remain a key focus for us. And in that context, we are almost complete with our branch expansion strategy. And clearly that needs to be complemented by an appropriate electronic banking strategy, whether that's internet banking, new business online for our corporate customers.
So are you looking at opening new branches this financial year?
We will complete another 3 branches this year, which we were committed to already in 2010. So we are committed to opening those 3 branches this year. We will continue to review. There's a couple of other economic centers in the country where we think it's important to have a physical presence. But we think it's much more important to ensure that we have a full range of options for customers in terms of how they engage with CFC Stanbic, whether that's electronically or through physical branch presence.
And moving forward, Greg, what are the expectations for CFC Stanbic Bank moving into 2011?
As far as 2011 is concerned, we think that economic conditions will continue to remain relatively benign and favorable for growth, notwithstanding the recent upheaval in some of the markets, I mean, occasioned by concerns around oil, inflation, and just generally stock markets have been on the decline. And currencies, there's been marked volatility, not just in the Kenyan shilling, but globally. We expect those to be relatively short-term and to work their way through the system and not to have an overly dramatic impact on potential growth. So we see positive growth in 2011, some adjustment in the macroeconomic fundamentals, but nothing that would represent an exogenous shock and cause us to revise our expectations for 2011, which is for further growth in earnings and an improvement on shareholder returns.